Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins. Today I want to talk about three things. I want to talk about follow-up to our natural gas post of a few weeks ago. I want to talk about the millionaire and billionaire tax. And lastly, we'll spend a little bit of time talking about the markets. So let's get started. In my post of a couple of weeks ago on natural gas, I talked about January 1st, 2009 to January of 2012, a 3-year time frame. And I said that the price of gasoline had gone up from $1.87 to $3.87. It more than doubled. And I used two gas cans of different size to show the magnitude. What I realized that after I did that video, that there was an alternative way to say it. Not that you're particularly going to like this, but the inflation factor for energy in terms of crude oil, gasoline at the pump, for that same period of time is that the inflation rate on the price of gasoline at the pump in the first 3 years of the Obama administration has a 25% annual compounded increase. 25% per year over 3 years, more than doubles the price. So that our energy costs, adjusted for inflation, have, while they've more than doubled, they've actually, in a relatively short period of time, gone up 25% per year compounded. Now, we talked about how the price of energy was a little less than $1,000 per household in 2009, and now it's a little less than $3,000. And probably by the time this video gets out to you, it will have gone up again. We are paying for this time of year the highest price we have paid for gasoline. The president would lead us to believe that it's the oil companies that are gouging the American public. I'm not sure that I can I agree with that, but I can substantiate what the profits have been for the largest oil company in the United States, ExxonMobil. And you're about to see a picture of the earnings of ExxonMobil per share over the last 4 years. And you will notice that it is not growing anywhere near 25% compounded on an annual basis. In fact, some years they've gone down. So we're paying a price for energy because of what's going on in the Middle East, and the president has spoken about that. We have paid a price because we don't have an energy policy in the United States. I tried to do a search on the number of permits issued by the federal government to drill on public lands in the 3 years that the president's been in office. One well has been sunk. There have been 50 well permits granted, but not really anything on the government land. All of the development, all of the exploration is taking place on private lands. I would expect, as long as tensions continue to stay high with Iran and their quest to destroy Israel and the United States, we will continue to see high oil prices. I saw a report recently that said that the target price in this run could be as high as $125 a barrel. That would put us over 4, and in some cases over 5 or 6 in different areas of the country. Energy is going to be important. Natural gas can be a solution to our energy problems here and now. Let's move on to the president's millionaire and billionaire tax. You may recall that the president wanted to put a flat tax of 30% of all the income that people made over $1 million a year to help fund the budget deficit. And he said that everybody paid their fair share, and the people who made over $1 million a year paid a 30% tax on their income. We would help bring in more revenue and shrink the budget deficit. And when the president started down that path of wanting to put in the Buffet tax, taxing people who are making over $1 million a year, the administration estimated that it would produce about $1 trillion of income over 10 years, or about $100 billion a year in new income to the government, which would help offset the deficit. The Joint Committee on Taxation of the Federal Congress, a bipartisan group, just recently revised its report on the impact of charging 30% to all people in the United States for all income above $1 million. Their estimate is that will generate over 10 years $47 billion. Not $47 billion per year, but $47 billion for the 10-year period. A far cry from the $1 trillion that the Obama administration estimated. So 30% isn't enough. And it would appear that if you tax the income over $1 million at 100% tax, you still can't get to the $1 trillion that the administration projected that it would produce. So the Buffet tax, while making good political rhetoric, the Congress, both Democrat and Republicans, have run the numbers, and it's only worth $47 billion. They're going to have to find other ways either to generate more revenue, or is it possible that the middle class is going to have to pay more in taxes? Only time will tell. Lastly, the markets. We have the S&P 500 over 1,400. I didn't think it would break 1375. It did. I was wrong. I don't think I'm wrong longer term. The market seems to be getting more and more churn related, meaning it goes up, it goes down, it goes up, it goes down, but it's not making big significant process. On Thursday of this week, we have the gross domestic product for the first quarter, and the estimate is going to be initially somewhere in the neighborhood of 2% for the annualized for the year. There are some people, myself included, who think it probably could come in there, but second quarter could in fact be below 2%, and that for the year we would come in at somewhere less than 2.5% for the year. We still have a problem of unemployment, and while some of the pundits are talking about how well the unemployment rate is doing, the administration is now warning people that just when they took people off the rolls and reduced the size of the workforce looking for work, which gave us a decline in the unemployment rate, as the unemployment rate has come down to about 8.3, there's a possibility those people who were no longer on the rolls start coming back looking for work, which could change that factor, and we could in fact see unemployment begin to rise towards the middle of the year or as we get closer to the election. We still have people who now think that the Federal Reserve is going to start increasing rates sooner than 2014 because of unemployment and because of the economic growth. I don't really think that a 2% economic growth, an unemployment rate north of 8%, and a housing market which was reported this morning, today, Tuesday, fell again. These are all signs that the Federal Reserve is going to be more strict in their policy, and they're going to start raising interest rates sooner than later. I think if I'm right that we start to see a rise in unemployment towards the middle of the year, no improvement in housing, and the economy still cruising along at around 2% plus or minus, the Fed is going to reiterate that it's going to be staying on hold till at least 2014. So I'm still looking for a correction. I believe that correction will come before the presidential election in November, and I think it could be pretty severe. So it's important to watch what's going on, understand the politics of what's going on, and I'll do my best to try and help you. That's it for now. So if you have questions, you can give me a call or send me an email. I'd be happy to help you. Thanks for watching.